Hello guys, in this video we will analyze popular patterns for stock markets which can also be applied to various complex instruments, for example currency and cryptocurrency pairs. And so day traders often use them when trading with leverage on the derivatives market. And so with knowledge about these tools you will be able to identify market entry points and benefit from various situations that develop in price candlestick charts. And so, let's start. Why are chart patterns important? Well, chart patterns are important in trading because they are closely intertwined with the psychology of price action. So price chart analysis first appeared in the 17th century. It is more convenient to analyze assets price patterns in a candlestick type of chart since Japanese candlesticks provide more information. We have a price opening, price closing, price movement high and low, and it is important not to confuse price patterns analysis with candlestick chart pattern analysis, which is based on assessing the appearance of one bearish or bullish candle. And so, as a rule, candlestick patterns are cyclical and repeat the movement, forming price patterns in the form of figures. And so, based on these candlestick patterns, a professional trader and a beginner can predict further price movement and open profitable trades, setting clear goals for this movement. And so, examples of price candlestick charts are such as double bottom, double top, head and shoulders, inverted head and shoulders, rising wedges and falling wedges, flags, ascending triangle, descending triangle, and many others. And so chart patterns are an essential tool for trading to analyze market movements and market-informed decisions. And so these patterns provide insights into the psychology of market participants and help traders identify potential trends and reversals. So now, let's discuss how Forex chart patterns work. Well, Forex graphic chart patterns are models that day traders use to determine the direction of price dynamics based on its movement in the past. And so the main purpose of graphic chart patterns is to provide the trader with information for opening a short or long position based on statistical and graphical data. And so the trader aims to do, of course, based on that, profitable trades. So, in terms of how to read chart patterns, we can say that they are easy to identify with the help of Japanese candlesticks, bar and line figures. But there are two types of candlestick patterns in the graphical analysis. The first one are reversal, bearish or bullish patterns. So, these are head and shoulders, inverted head and shoulders, double top and double bottom, rising wedge in an overall uptrend, and others. Then we have second, which are trend continuation patterns. And so here we have rising wedge in a downtrend, falling wedge in an uptrend. Then we have a bullish and bearish trend rectangle. Then bearish and bullish pennant. And next one are symmetrical and ascending triangles, and of course descending as well. And so now let's discuss 10 most common day trading patterns. And so in this section, we will analyze the top 10 trading candlestick patterns that appear most often in the chart when trading intraday. And so, first one we have cup and handle. And this chart pattern occurs on various timeframes and is suitable for intraday trading. And so the pattern can be found in almost all financial complex instruments. The cup and handle chart pattern is a continuation of a primary trend in the upward correction. However, it can also be a bearish trend reversal chart pattern. And so we have this 15-minute Euro USD chart, in which you can see an example how to recognize a pattern of cup and handle. And so in this current situation, it was possible to open a trade after the chart pattern was completely formed and the broken resistance level was retested. So this screenshot shows that the resistance became then a support level. And a bullish hammer candlestick pattern was formed above it. And so exiting the handle was a long position signal. And so the price movement is calculated from the bottom of the cup to the resistance or even higher. And the stop loss should be placed below the newly formed support line. Then we have triangles, and so the appearance of triangles patterns in the chart makes it difficult to predict the price movement since there are three types of this chart pattern. We have a symmetrical triangle, and the formation of this type of continuation patterns looks like a narrowing of a price swing highs and swing lows. In the current case, it is difficult to predict the movement of the quotes. So there is a considerably high risk of a bearish and bullish traps, which can lead to losing money rapidly, which is why it is important to wait for the triangle to be confirmed up or down and the price to consolidate higher. It is advisable to wait until the price tests the broken level. And so the price movement implies a symmetrical increase or decrease in quotes. And in here, in the 30-minute UK Brent price chart, there is a formation of a symmetrical triangle. You can see that there were attempts to trap both bears and bulls. And in the current situation, before making a decision, wait for the breakdown of the triangle up or down. Stop loss should be placed in the middle of the narrowing channel, and for a more accurate picture, Japanese candlestick patterns analysis should be used. And so the bears made an attempt to break through the lower border of a triangle. However, the bulls repelled the attack, we could say, thus forming a bearish trap of candle squeeze. And so in this case, you need to wait for the final consolidation of the price and then open a trade. Next, we have ascending triangle. And so the ascending triangle continuation pattern has a clear horizontal resistance line. Upon reaching it, the quotes reverse, forming rising lows. So after consolidation, the asset price breaks through this resistance level and the price continues to rise by the height of the ascending triangle. And now we have this 30 minutes BTC USD chart, which is a Bitcoin chart, which is an example of the formation of an ascending triangle. And so in this screenshot, we can see the formation of a resistance level and rising lows, after which there was an impulse breakout of quotes and price consolidation above the resistance. And so after retesting the level, there was an opportunity to open a buy position with the target at the height of the formed triangle. Stop loss in this case is placed below the broken resistance line in the distance of the low of the impulse candle. Next one is, yes, we had ascending, now we have descending triangle. So the descending triangle continuation pattern is the opposite of course, of the ascending triangle. In this figure, there is a clear support level and a smooth decrease in highs. As a result, the lower price trend line is broken and the price continues to rapidly decline by the height of the triangle. And so here you can see the descending triangle in the 15 minutes chart of the XAU USD, which is of course gold. And so here the formation of the candlestick pattern is clearly visible. Quotes were prevented from moving below the support level several times, and at the same time there is a decrease in the highs of the instrument. And so after the consolidation of the particular asset, the support level was broken and the price went down. And so a short sale can be made only after the price consolidates below the support line. Take profit should be placed by measuring the height of the triangle as in other types of this candlestick pattern. And so next we have the stop loss, which in this case is placed above the support level. So next pattern is a flag. And so the flag is a trend continuation pattern. There are two types, bullish of course and bearish. And so the price constructs a flagpole, then comes the flag and impulse breakdown of quotes when the price leaves flag by the height of the flagpole. And so this candlestick pattern is suitable for intraday on 5, 15 or even 30-minute timeframes and is one of the best figures for day trading. The 30-minute USD JPY chart here shows a clear formation of a bullish and bearish flags. So, after active growth in the bullish flag and decline in the bearish flag, quotes are consolidated in a descending or ascending rectangle, which forms the pattern. And now, buy or sell only after the price has exited the pattern. The stop loss order should be placed just below or, of course, above the flag itself. And so depending on whether it is bullish or bearish, the target for this pattern is equal to the height of the flagpole. Then we have next figure, which is falling wedge. And so the falling wedge is one of the continuation patterns that resembles the triangle chart pattern. So novice day traders often make mistakes when opening trades. The main difference between a falling wedge and ascending triangles or descending triangles is the downward trend of support and resistance lines, while a triangle has a clear horizontal lines of support and resistance. As part of risk management, price movement must be defined as the height of the wedge itself. And so, however, with a massive increase in trading volumes, quotes may go even higher. And so you can see an example of the falling wedge in this chart, which is M15 chart of Apple. And so this screenshot shows that the price was gradually decreasing after the prevailing trend in bullish direction. And so while the lows and highs of the price were declining. After the narrowing of the trading channel, there was an impulse breakdown of quotes upwards. After waiting for the retest of the broken resistance line, we could open a buy trade with the target higher by the level of the falling wedge height. Stop loss in this case should be set at the lower border of the trading channel.